Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so that's an example of a long call. I think we've all been there. Let's get into, seen a question pop up here. Let me see. In the money and 5 to 5 months out would be very expensive option for a trade that is expected to last just 2 weeks. What's the justification for going so far out? Great, good question here. I'll kind of give you an example here. So if I told you that you could rent an apartment, let's just say it's a one-bedroom apartment, and you would pay, let me see if I can think of some math here that would work. You would pay $500 a month for a 9-month contract. Or you could do a month-to-month lease of, so month-to-month of $600. So you'd be paying a 20% premium in order to rent it month-to-month. Hey, I don't know if I'm going to need it for 2 months, 3 months. I don't know if I'm really going to need it for 9 months. Probably not. But then you ask the office or the landlord, you go, well, let me look at the contract. So I understand it'd be $500 if I signed a 9-month lease, or it would be $600 for me to do the month-to-month. And landlord said, yeah, that's correct. Well, what's the penalty for me breaking the lease early? We have a $150 penalty if you break the lease early. Do the math on that one and think about it. That's kind of how I associate this. Is if it's only going to cost me $150 to break the lease, I think of it as, wow, I'm going to sign that 9-month contract knowing full well that my break-even point is really a month and a half into it. I can get out of this contract. So if I'm in the apartment for more than a month and a half, 2 months, 3 months, and then in the 4th month, hey, I'm going to break the lease. Yeah, I get it. Here's my $150 penalty. But think about the money that you saved, and that's how I associate it as well. Now, of course, it depends on the volatility and what you're doing, but generally speaking, if you get more time, and then if the trade doesn't go the way that you anticipated it, you can always close out the trade. Sure, I know there's commissions, but by having more time than you need, then you're going to be able to typically recoup that because the theta hasn't eaten it down so much. Yes, 2 weeks is a very short amount of time. If you're looking at, let's say, 3, 4, 5, 6 weeks, as I typically will design my spreads, then, hey, that's more like the lease thing that I talked about. Now, also, think about this. You could always leg out of a spread. You could roll it out. You could roll it up. There's a lot of things you could do. So you could start with one style of spread, and then you could morph, M-O-R-P-H. You could morph that into a different style. Again, you'll have to calculate, how your broker charges you for commissions and, really, do you want to be in it this long? Okay, great. So Tina's saying, so he is saying theta decay is a lot smaller on a further out option, right? Yes, absolutely. That's what I'm saying. The more time you buy, the more that you get it at a discount. Yes, I know it's more expensive, but it has higher value to you. Same thing with Delta is, hey, by buying more in the money, Shawn, you're really spending more money. Yeah, I'm spending more money, but I'm getting more value, especially if I believe in the chart that I'm looking at. Now, if it just comes down to me outright speculating, just purely speculative, hey, I don't know if this is going to happen at the company. I don't know if they're going to get this approval for a new kind of drug. I don't know what's going to happen in this court case. If we're absolutely playing lottery ticket scratching kind of trading, then sure, I may go for one of the cheapest options because I may treat that binary. What I mean by binary is, hey, so I put a couple $100 in. If I'm right, wow, this thing's going to explode and I'm going to really clean up. If I'm wrong, this was a speculative gambling style trade anyway. It's a couple $100 wasted. That is not what I'm talking about here. I'm talking about being in on ETFs and trends that you feel have the legs to get you through a couple of weeks, possibly even more than a month, maybe even a quarter here. And if you look back at the market that we're very possibly coming out of right now, that market did have those kinds of legs that you could set up those kinds of trades. Okay, talking a lot about legs, and I don't mean to confuse the subject, but I'll get into what is a bull-call spread. We'll think about the components here. One, I'm bullish. So you know I'm bullish by the nature of this strategy. So what I really need to have is I need to have uptrending indices. I need to see, before I'm going to put on some bull-call spreads, I need to see uptrending Dow, uptrending S&P, uptrending NASDAQ, uptrending Russell, uptrending mid-cap. If I don't have that, if I've got a Dow and an S&P that's going up, but a NASDAQ that's neutral, and a mid-cap and a Russell that's going down, if you look back at the markets, historically, you don't find that the indices go in opposite directions for very long. One of them, or both of them, or all of them are going to eventually start going the same direction. And this is the nature of how institutional money flows into the markets, plural, and out of the markets, plural. Yes, there's sector rotation, but trying to capture some of those sector rotation trends can be tough. So I'm looking for a bullish market, and I'm going to look at bullish indices, I'm going to look at bullish industries and sectors, and I'm going to be trading bullish ETFs or bullish stocks in there. I want to buy the strength of the market and the strongest sector and the strongest ETF and or the strongest stock. So I'm bullish, and I'm using calls, okay? If I'm bullish and I'm using calls, then that must mean that I'm buying calls. Now, of course, there is a credit spread, which is the flip side of the strategy I'm covering, which I absolutely love, but it seems that people have a little bit more of a challenge wrapping their head around that. So this is, I think, a great starting point. And I'm going to spread the trade. What do I mean by spreading? Well, by spreading, I'm going to be both a buyer of a call and a seller of a call. So I'm going to spend some money and pick up both a right, but I'm also going to collect some money, and I'm going to pick up an obligation. I have spread my risk, but I've also spread my reward. So I have both defined risk, and you'll see this as I go through it, and defined reward. It's a two-legged option strategy with a long leg. I buy a call, and I buy a call that is going to be more in the money or at the money. It's going to be a lower strike price. Then the short leg. I've got a long leg and a short leg. This costs me money. From this, I receive money. So really all this bull call spread is it's really just a covered call, except I don't have to go out and I don't have to buy the shares. Buying the shares costs me quite a chunk of money relative to buying the right to buy the shares. So by buying the shares and selling to someone the right to buy, by buying the contract, it gives me the right to buy the shares, but not the obligation. And by selling a call option, it gives me the obligation to deliver said shares. Let's move forward to the next point, and you'll start to get it. Step number one, long leg. Buy calls to open. Now, I'm doing this step by step. Just about every broker out there, from what I've seen, has the ability to do this as one unit. Back in the day when I first started trading, you had to leg in. You'd first buy your call. Once you'd bought your call option, then you could go and you could sell your call option and offset the premium. Now you could set it up as, here's leg one, here's leg two, and I want to do it for a net debit of 65 cents. If you can't get me 65 cents, then don't do either side of this transaction. Let's keep going here. Step number two is the short leg. Sell the call to open. Buy the call, you're going to be spending money. Step two, selling calls. Now you're going to be receiving money. Commissions here, commissions there, but the idea is that the selling of the call options will offset the cost. Not only will it offset the cost, it's also going to offset your theta, and it's also going to offset your delta. So you are going to be gaining, but you're also going to be giving up. With every single strategy in the market, there are things that you're going to gain, and there are things that you're going to give up. And see if I can get the name right. Tejbal, is this also called a vertical spread? Absolutely it is. This is absolutely a vertical spread, but I'm defining it a little bit further by saying it's a bull call spread. So I'm telling you a couple things. It is a vertical spread, but I'm bullish on the market. I'm using calls, and therefore I must be spending money making this a vertical debit spread. Okay, vertical call debit spread. All right. Step three, you got that covered. Step four, buy the spread as a net debit? Well, you're going to be spending money here. So this is the opposite of a credit spread, which hopefully Steve will invite me back and we'll talk about credit spreads one day, and then we can get into talking about iron condors, which are just two credit spreads. Now, the advantage of the bull call spread, well, it can be created for a bull and or a neutral market. So unlike a call option where you really can't buy a call that is so in the money that the option, or excuse me, that the underlying can go flat and you can still make money. So you can't really buy call options for a neutral market. Yeah, you can buy one in the money, deep in the money with a high delta, but you're still going to be paying for time. And time is, it's only one way. It can only move forward, so therefore that thing does have built-in time decay. But the beautiful thing about this is that you can create it for a bull market and or a neutral market. And then we'll just do that as we get kind of to the end of my presentation and take a look at how would I build one that is more conservative, that will work in both a bull and a neutral market, or how can I build one that's a little bit more aggressive to the bullish side that's only going to work in a bull market, but it's going to fail me in a neutral market. And one is not better than the other. One strategy is not better than the other. It's just you need to figure out where you're most comfortable with building your spread orders. Well, another advantage is that because you are offsetting the cost of the call option that you bought by selling one, you lower your break-even point at the same time. By lowering the break-even point, you increase the probability that you're going to come away with a profitable trade. So this is where people get into the whole discussion about high probability trading. Well, high probability trading, there's always the flip side. The thing about high probability trading like this is you're never going to be the person that gets to boast that you had, 5,000% return on an option contract, because you're giving up the upside potential and you're gaining the probability of success. This is what I find that most successful traders do. They give up that, wow, I'm going to make a ton of money in no time at all. They say, look, that's like scratching lottery tickets. That's all based on luck. There's no strategy on that. When the markets are doing what the markets typically do, which is a little bit bullish, a little bit bearish, a little bit neutral, all of those things, you can use a higher probability spread type of order or a series of spread orders, and you can get into the higher probability zone, but your rates of return are going to suffer. That doesn't mean they're bad. It just means that you're not going to impress anybody on an airplane ride where they say, hey, I've got a neighbor that was smart enough to buy lead contracts in Apple when it was $75, and now it's up here. He's brilliant. He's probably not brilliant. He's probably just lucky. Or if he runs around doing that kind of thing, he also probably did something like that in like a Bank of America, and he's given up a lot of it too. So one's not better than the other. It's really just based on probability. Another thing I like about it, just like the call option, it's defined risk. This is like a covered call, except you don't have all the downside of buying the stock. You don't have all the equity requirements of owning something. So it's defined risk. And another thing I like about it is it's adjustable. So going back to my point of buying more time than you need, if you buy more time than you need, then you can adjust the trade as you go. You can do ratio spreads. You can lift a leg. You can add a leg. There's a lot of things that you can do to adjust this trade. Even if you just start off, let's say you just start off with buying calls to open. So you started off with a long call position. And sure enough, it went up for a while. Let's say you buy yourself 6 months. In the first month, it went up. And in the next 2 weeks, it went sideways. Meanwhile, the Dow, the NASDAQ, the S&P, and the Russell, and the mid-cap are all kind of getting a little bit herky-jerky like they are right now. What's your fallback strategy? Since you bought the call to open, you basically have the long leg of the option. And it went up. Great. So now maybe you're beyond your break-even point. But now that it's gone sideways for 2 weeks, well, you have another choice besides hold it and let theta eat away at it if it's going to continue sideways, or sell it and capture whatever profit you have. And the option or the adjustability that you have at this point in time is, why not leg into a spread? So if you bought it at 20 and it's up at 21, and now it's going sideways, it's 21.05, 19.95, $20, back and forth. Hey, you know what? Maybe I'm going to go ahead and sell the $22 strike price and bring in a little bit of money. Or maybe I'll sell the 20 and make this a little bit more of a conservative spread as well. Okay, so that's some of the advantages of it. Let's get into talking about some of the disadvantages. Well, I don't like this, but this is the nature of the beast. You gain something and you give up something else. You have limited profit potential. Look, if this thing goes sky high, just like with a covered call, hey, you lock in your profit. You entered in this contract knowing the absolute worst scenario and the absolute best scenario. There is limited profit potential associated with a spread order like this. You're going to have commissions. Yeah, you're going to have twice the commissions. If you think about it, you've got to put on 2 legs to get going. And then in the very end, and you'll see this in a minute, you're going to have to put on 2 commissions to take it off. So yeah, you are definitely going to be generating more commissions associated with this kind of strategy than if you're just doing straight calls and straight puts. You know, there's another point, and that's called no man's land. And I'll talk about no man's land as I get into an example. But this is basically only getting kind of half of the distance that you thought you were going to get in your options contract, and you have to find a way to get yourself out of no man's land right at expiration or right around expiration here. Okay, let's go through a basic example before we get into one of the examples that I pulled off of the charts. So we're going to talk about theoretical XYZ before we talk about something real. Current price is $35. So here we are right here, $35. And you can see that we're in a nice uptrend. And like most uptrends, it pushes up, takes a little bit of a breather, pivots, pushes up, breather, pushes up, breather, pushes up, breather, pushes up. So we're not quite sure if we're going to get into a breather or not moving forward. After all, we have no idea what's going to happen next, but we do believe that this trend is still intact. So we start to think about how I can build a debit spread here. So here's the one I'm going to build. I'm going to buy calls to open. I'm going to buy the 34 call. Well, what do I know about the 34 call? Let's talk about what I definitely know about it. 1, I know it's in the money. 2, I know it has a higher delta than something that is at the money or out the money. So it looks and smells a little bit more like owning the stock, which in reality what we're really doing here is very much a covered call type of strategy. So if I spend $1.40 on that, well, think about if I just bought the call option, 34 plus $1.40, it's got to get to $35.40 before I break even at all. So there's a little bit of price performance pressure associated with just buying the call. But I'm not just buying the call. I'm going to sell a call as well, and I'm going to make this a spread order, bull call spread. So selling calls open, the 35, well, what do I know about the 35 strike? Well, the 35 strike is probably going to have a delta somewhere around 0.5 to 0.6. I also know that the theta of an at-the-money call option is higher than anywhere else basically on the entire option chain. What I know about buying one in the money is that I'm paying lower theta. Can't give you the exact number, but that's just how it works. This at the money, if you're a broker, is often called the sucker trade because you're spending, I call it the sucker trade, and my colleagues that I trade with call it the sucker trade. You're paying more for theta than anybody else is, and your deltas really aren't that impressive. They're about 0.5, maybe a little bit higher. So this one is kind of the sucker trade. If you went up here higher, although you would be lowering your delta, you would also be lowering your theta. Theta is highest right here. So we sell calls to open, the 35, and we collect 75 cents. That 75 cents offsets the cost of the $1.40. Let's take a look at the analysis. The break even of this, because we could set it up for a 65 cent debit, is going to be $34.65, which is our long leg plus the cost of our net debit, which is 65 cents, giving us a break even of $34.65. Maximum gain enters the picture if the stock can stay at 35. If you think about what you have here, you have an obligation to deliver shares at $35, shares that you don't have yet, but shares that you can acquire at 34. The only way that someone is going to request that you sell them shares at 35 is if the price goes above 35. So upon expiration, if the price is at 36, 37, 38, the guy or gal that bought this option from you comes and knocking, and they want their shares at 35. Where are you going to get them? You're going to exercise your right at 34. and you're going to sell them at 35, and of course this all happens automatically at expiration if both of these legs are in the money. So your max gain will come at $35 or higher. 36, 37, 38, it doesn't matter. You won't make any more money. And your maximum gain here is 35 cents. Okay, well, 35 cents, that really doesn't sound very impressive considering my maximum loss comes in at $34. Hey, anything below 34 bucks and I'm losing. I'm breaking even at 34.65. I can't lose any more money than 65 cents. That comes in at $34. So if it's at 33, 32, 31, nobody in their right mind is going to buy shares from me at 35. Shares that they could go and they could buy in the market for 34 or 33, so on and so forth. So the max loss comes in at $34, and that would be 65 cents. The return versus the risk is a 53.8% return on risk calculation. Well, this might not seem very good. Hey, why am I going to risk 65 cents to make 35 cents? The reason you would risk this is the probability. Here's a trade that if the current price continues at $35, a price that it is already at today, if it can just stay at 35, I will make my 53.8% return on risk. If it can go to 36, all the better. I don't make any more money, but it builds in more cushion. So this is a trade that gives me a healthy return on risk in a neutral market or an upward market. And this will even make me money at a price point of $34.65 and up. So I even built in a 1% cushion. Granted, 1% is not a great deal. So when I'm looking for a bull call spread candidate, I'm not looking for a high flyer. I'm not looking for a stock that can move 3 and 4% in a day. I'm not looking for an ETF that's done 8 or 9 or 10% in the past month. I'm looking for something, believe it or not, that is relatively quiet, that doesn't have a lot of gapping, that has enough liquidity that there's not going to be one person that can manipulate the price very easily or that they can affect the price very easily. I'm looking at a very quiet, boring stock because if this spread's going to last, let's say, 4 weeks, all I want the position to do is move towards expiration without dropping in price. If the stock that I've been looking at has a very volatile nature, well, then I'm probably going to get whipped all over the place. So I can look at stocks. If you want to take a look at a few of them, I can look at stocks like ADP. I can take a look at that one, or Smucker's Jam, SJM, or Heinz, HNZ. I can look at some stocks that have had very, very consistent, quiet trends that isn't the focus of where everybody wants to go. Everyone, hey, how do I trade oil? How do I trade Libya? How do I trade Japan? If you're doing something like this, which is a relatively conservative trade, you don't need to trade those kinds of things. You can find things that are more stable, that can hold their own against a volatile market.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.